Hey everybody, Smart Silver Stacker here. Today I've got a quick market update for you. We're going to talk about what's been going on with the price of gold and silver recently, and also we're going to be diving into some fairly ominous economic reports that we have coming out of the New York Federal Reserve and also the G20's Financial Stability Board. Now that one relates specifically to the risk of shocks within the world commodities markets and the threat that that poses to the global financial system. So I think that one's going to be of particular interest to all of you stackers out there. So stick around because we got a lot to cover in today's video. And today's video is brought to us by Silver Botanicals line of household and personal hygiene products that are powered by Nano Silver. You can check them out with the link down below. And remember to use coupon code STACKER to save 10% on your order. And now let's get right into the gold and silver markets. So I actually took yesterday's market action as a very positive sign for the precious metals. We had the PMI data come out. It was hotter than expected, and stocks sold off pretty heavily on that news. Now, this was a classic example of the good news is bad news dynamic that we have been witnessing in these markets, in which really the only thing that's driving prices is the expectation of what the Fed is going to do next. The PMI manufacturing data, it came in at 47.8. That was better than a 47.4 that was expected. And then in the service sector is pretty much the same story. We got a 50.5 print versus the 47.3 expectation. So it was a huge beat there in the service sector. Both numbers were up from January. And so ostensibly, this is good news for the U.S. economy. Although, I suppose that's relative. Likely, these numbers are manipulated to paint a rosier picture than what's actually occurring on the ground. But regardless, markets did sell off heavily on this news. And again, the idea here is that the Fed is going to take this economic data as a sign that it can continue to tighten its monetary policy. And, easy money, it's the only thing that these markets want. And so stocks tanked on this news. But metals, on the other hand, were actually quite resilient. If we take a look at the charts, courtesy of SD Bullion, and by the way, if you're new to stacking gold and silver, you should check out sdbullion.com/new because right now you can get your first order at spot. We can see here that the gold price did drop a little. It's down under 1850, but silver was actually just very slightly green on the day. Now, it's dropped a little bit today, but basically the metals were flat on the release of the PMI data. And compared to the major stock indexes, this was a sign of considerable strength, if you ask me. Now, the Fed this afternoon is going to be publishing some notes, and the markets are going to be watching that closely to try to get a hint of what's coming at the next FOMC meeting. And according to the CME FedWatch tool, the probability of a 50 basis point hike is rising. It now sits at 21%. If you ask me, all of this stuff with the Fed, all of this hoopla about, whether they're going to raise 25 basis points or 50 basis points, I think it's all really just kind of theater and noise. Bottom line is the Fed is going to keep hiking, and then, eventually something is going to break, and then they won't be hiking anymore. In fact, they'll probably ease. And all we need is a good crisis, and then they'll have the excuse to fire up those printing prices once again, regardless of where inflation is at, and then inflation is going to get much worse. That's my forecast anyway. And if you want to get an idea of why the economy is almost certainly guaranteed to break under these Fed rate hikes, we need look no further than this household debt and credit report for Q4 of 2022, which was just released by the New York Fed Center for Microeconomic Data. And according to this report, U.S. household debt just hit a record $16.9 trillion. Now, that's a 2.4% increase from the previous quarter. So, if you annualize that rate of growth in household debt, you can see that we have a real problem here. And credit card balances increased by $61 billion. They hit $986 billion. That surpasses the pre-pandemic record of $927 billion. Mortgage balances are up to $11.92 trillion. Auto loan balances are up to $1.55 trillion. And student loan balances are up to $1.6 trillion. Now, perhaps the single most important piece of information that was contained within this report from the New York Fed is that the share of current debt transitioning into delinquency increased for nearly all types of debt. Now, you don't need to have a PhD in economics to understand why the combination of rising interest rates, along with this massive amount of leverage and now increasing delinquencies across all sectors of the U.S. economy, is a recipe for disaster. And this was not the only ominous economic report that we just got. We also had this report from the Financial Stability Board, or the FSB. Now, this is an advisory board that coordinates financial rules for the G20 economies. This report is titled The Financial Stability Aspects of Commodity Markets. And in this report, the FSB is warning us that, quote, continued geopolitical tensions and heightened macroeconomic uncertainty in an environment of tightening financial conditions raise the risk of further significant volatility in commodities markets. So they're warning us of shocks in commodities markets and perhaps the financial system more broadly. Now, this is on the tails of the big swings that we saw last year in 2022. That was following Russia's invasion of Ukraine. We saw oil and natural gas both spike up. We saw palladium had a huge swing up. Pretty much all the industrial metals saw big gains. And also the nickel market, very notably, pretty much broke. I mean, the LME was forced to halt paper nickel markets for some time. I think it was a period of weeks. Once the price of nickel exceeded $100,000 a ton. Now, I believe that we saw about a 270% increase in the price of nickel in one trading session. That's if my memory serves me. And according to the FSB here, the risk of similar events taking place still persists. Writing in this report, quote, the use of leverage can lead to liquidity stress in the event of margin calls on derivative positions and collateral calls on short-term borrowing. There is opacity in some areas of the commodities sector, including over-the-counter derivatives markets, where it is difficult to obtain a full picture of the size or network of exposures across jurisdictions. So basically, who knows how much leverage is being used in these commodity markets? We do know that, in the gold and silver markets, for example, there's a tremendous amount of paper that is being traded for every ounce of the underlying physical metal. And as the report states, these global commodity markets, they're opaque. And the scale of the leverage in these commodities derivatives markets is, to a large extent, completely unknown. Now, as far as the risk of a commodity shock and increased volatility, this is what the report had to say. Quote, in the event that this happens, several important channels of contagion could become salient. CCPs, now that's commodities, firms, and central counterparties, and clearing members would need to make further margin calls. Banks may choose to limit their credit exposures, and market participants might cut back their trading in both cleared and non-cleared markets. These actions could exacerbate liquidity mismatches in markets, thereby propagating shocks in commodity markets and perhaps the financial system more broadly. Now, I think that a major takeaway for us based on this report, an actionable takeaway, is that if you are invested in commodities, especially gold and silver, you really want to take delivery of the physical metal itself, because if we get major shocks to commodities prices or to the financial system as a whole, we've already had a preview of what we can expect with the LME shutting down the nickel market last year. They basically penalized all of the investors who were holding paper long contracts for nickel in order to save the billionaire nickel magnate guy who had these enormous short positions. And one of the reasons, that we hold precious metals in the first place is as a hedge against these catastrophic tail risk events. And paper, gold, and silver, folks, they're just not going to cut it. So, it's been said countless times, especially in the stacker community, but it bears repeating given the current circumstances in the market. If you don't hold it, you don't own it. Now, they mentioned in that report the geopolitical risk posed to commodity markets. Now, let's do a quick World War III update here before we wrap things up today, because we've got a lot of developments on this front as well. On Monday, President Biden made a surprise visit to Ukraine. Now, in this trip, he announced another $500 million in arms support for Ukraine, and that's a trend that we are going to continue to witness throughout this year. More and more money being poured into this conflict, and of course, that is not going to help the Fed in their inflation fight one bit. In fact, it is a tremendously inflationary thing. War and conflict in general, especially when you're financing it via borrowing, it is probably the single most inflationary endeavor a government can take on. And I know that we're not, directly at war right now, but for all intents and purposes, we are involved in this World War III conflict by proxy. And, possibly this year we're going to get involved directly. Now, at the same time that Biden was visiting Ukraine, Russia supposedly conducted a test of its Sarmat 2 intercontinental ballistic missile. Now, I've read reports that this test failed. I mean, I'm not sure if that's really the case or not. I don't know all the details. You got to take that report with a grain of salt. But hey, these things do happen. Even SpaceX rockets don't work 100% of the time. But the important thing to take away here is that this is just another further ratcheting up of tensions, and in a very big way. And also, on that same note, Vladimir Putin has just pulled out of the START treaty. That is one of the few nuclear treaties that was still ongoing between the United States and Russia, one of the few arms controls agreements. And so that one is now off the table. And of course, this puts us one step closer to a possibly nuclear World War III. And also, we've got Xi Jinping now apparently planning a trip to Moscow. He's deepening Russia-China ties, and I mean, that's really no surprise. The lines have already been drawn in this growing global conflict, and we know what side China is on. Now, undoubtedly, they're going to be discussing a host of issues ranging from, potentially military cooperation to economic ties, and almost certainly they will be discussing ways to undermine the dollar further in their ongoing campaign of global de-dollarization. Now, I'm no fan of the CCP and Xi Jinping and authoritarian despots around the world, but I did think that it was kind of funny that recently Secretary of State Blinken accused China of supplying weapons to Russia or considering supplying weapons to Russia and warned them that that would be a huge mistake. Now, I mean, talk about the pot calling the kettle black here. I mean, we're openly funneling enormous quantities of munitions and support into Ukraine. And honestly, I mean, I'd be surprised if China wasn't already supplying weapons to the Russian war effort. Now, I haven't seen any evidence of that, but I mean, come on, we know who's on whose side here. And Russia and Iran and China are forming sort of this new alliance. We've got Iranians supplying drones to Russia. They're also working on the economic front with this gold-backed stablecoin that the Central Bank of Iran and the Central Bank of Russia are collaborating on. We had the Iranian president recently wrap up a trip to China. We've got Gazprom, the Russian energy company. They're developing Iranian gas field. So the ties between these powers are deepening by the day. And they're probably going to get a lot deeper later this year in August when the BRICS nations hold their summit in South Africa. And we may very well see Iran inducted into the BRICS organization, and potentially even more disruptive, we might even see the Saudis joining. Now, speaking of the Saudis, they just saw record oil revenues for 2022 is $326 billion. It's not an all-time record. I think that was set back in 2012, but it is the highest amount of oil revenues that the Saudis have made in a year since MBS has been calling the shots. So it's certainly significant. And the Saudis, they may join BRICS, they may not. They're going to do whatever is politically expedient for themselves. The Iranians, on the other hand, I think they have a bit more of a bone to pick with the U.S. They are an extremely heavily sanctioned nation, and they're more firmly in the Russia-China camp. But, the Saudis are going to do what they think is best for business. And honestly, who can blame them? I mean, they're just looking out for their own best interest. And we do know that they have become deeply economically integrated with China. China is now their largest trading partner, and they have promised to make providing energy to China their highest priority for the next 50 years. So, very likely they're going to wind up in that rival camp as well. So, it's not looking good, folks. World War III is well on its way to turning into a full-blown global conflict, and the economic aspect of that war is going to continue to threaten global dollar hegemony. So we're going to keep doing what we have been doing, stacking hard assets, getting prepared. I think we all need to be getting our beans, bullets, and band-aids in order at this point. And also, get your financial house in order too, because even though inflation is basically out of control at this point, and things do seem tough now, they are probably going to get a lot tougher. So we all need to be taking advantage of the opportunities that still exist in today's economy and doing everything we can to get prepared. And that's pretty much it for today, everybody. Do want to say a big thank you to all of you for watching. Leave me a comment down below to let me know what you think about these developments. And stay safe and happy stacking, everyone. Smart Silver Stacker, out.